Welcome to The Explainer. Okay, we need to dive right into an absolutely unprecedented market event that just played out overseas. And more importantly, we need to talk about what it means for your portfolio right here at home. Because honestly, we're seeing echoes of a massive crash reverberating through global markets, and we really need to figure out if those same warning signs are flashing for us right now.
So get this, South Korea's stock market, the Kospi, just went through its fastest and largest drop in history. It plummeted a massive 25% in just 3 weeks. 25%? To put that into perspective, this wasn't some slow, agonizing bleed over a tough year. This was an absolute free fall that caught millions of people completely off guard.
And the human cost of a free fall like that is just staggering. This drop wiped out 1.2 million retail accounts. That's roughly 1 in every 30 people in the entire country waking up to find their investments completely liquidated. Poof, gone. But the real question we need to answer today is, why did this happen? And is the US next?
Let's get into Section 1, the South Korean AI crash.
Understanding the mechanics of that overseas crash is absolutely essential if we want to spot the risks hiding inside our own market. And the core issue there? Concentration. Just 2 AI memory chip stocks, Samsung and SK Hynix, made up a staggering 56% of their entire stock market. Think about that. When a market is that incredibly top-heavy, it's not really a diversified index anymore, right? It's effectively one giant singular bet on the continued success of AI memory chips.
Now let's compare that to the US. Our top 10 stocks currently make up about 37% of the S&P 500. So, okay, we aren't quite at South Korea's 56%, but 37% is historically a very dangerous level of concentration. Basically, if those top tech stocks stumble, they're going to drag the entire market down with them, even before any actual panic selling begins.
Moving on to Section 2, Anatomy of a Doom Loop.
So how exactly did 1.2 million accounts get wiped out so fast? Well, it wasn't just falling stock prices. It all comes down to leverage and a terrifying little mechanic known as the Doom Loop. Here's how it works. Retail investors borrowed heavily using 2x single-stock ETFs. When U.S. chip stocks dropped, it triggered margin calls, meaning brokers demanded cash. And when investors couldn't pay up, the brokers automatically force-sold their shares right into a falling market. That tanked the price even further, which, you guessed it, triggered the next wave of margin calls. Nobody actually chose to sell. They were literally forced to.
Normally in a standard market correction, you only see about 2% of accounts get forced liquidated. But during this specific crash, because everyone was so heavily leveraged on the exact same AI stocks, that number spiked to 10%. It effectively poured gasoline on the fire, accelerating the crash totally beyond anyone's control.
Now, thinking about the US, every major spike in borrowed money has preceded a massive market correction. And right now, in 2026, our margin debt just hit a record 4.5% of GDP. That is $1.5 trillion of borrowed money sloshing around the market. That's actually higher than the dot-com bubble and higher than the 2007 financial crisis.
Which brings us to Section 3, the AI hype machine.
Because here's the thing, leverage is only half the equation. To get borrowed money this high, you need absolute, undeniable market euphoria. Take the new SpaceX IPO, for example. The reality is they're a rocket and satellite company currently losing money at the operating level. Yet they are going public seeking a $1.75 trillion valuation. How on earth do they do that? Well, they're pitching themselves as an AI enterprise, relying heavily on their Grok AI model, which actually accounts for a tiny fraction of their business.
And because of that AI branding magic, they're hitting the market at a staggering 90 times price-to-sales ratio. To show you just how extreme that is, massively profitable, established AI companies, think Google or Meta, they typically trade around a 10 times price-to-sales ratio. 90 is just wild.
And here is the giant waving red flag for regular investors. SpaceX is reserving an unprecedented 30% of its IPO shares specifically for retail investors. Because of that, there are very real fears that everyday people are being invited in simply to become the exit liquidity for a hyperinflated AI bubble.
All right, Section 4. Is the US next? With financial influencers pumping zero-revenue AI mining stocks, IPO mania reaching an absolute fever pitch, and margin debt sitting at all-time record highs, we have to objectively ask, is the U.S. market going to follow South Korea?
Now, South Korea was concentrated in just 2 memory chip companies, but the US market is deeply, almost circularly connected. Companies like Nvidia, Microsoft, Meta, and Google are essentially passing money back and forth. Nvidia sells the chips, Microsoft and Google buy them, and they kind of artificially boost each other's earnings in this closed ecosystem.
But, to be totally fair and objective here, the US is structurally different, and there really is a strong bull case. Our AI infrastructure companies are actually generating real revenue, seeing earnings growth near 25%. Plus, the market rally is broadening out to smaller companies. For example, the Russell 20,000 is up 16%, which is a much healthier sign than a market propped up by just 2 stocks.
Let's wrap it up with Section 5, the trillion-dollar question.
So if we aren't exactly South Korea and we actually have real earnings, what's the single metric that could trigger a US market collapse? Where's our breaking point? Honestly, it all comes down to this expected spend. The entire US AI stock market is currently propped up by Microsoft, Google, Amazon, and Meta, spending hundreds of billions on CapEx, capital expenditures, to build out their AI infrastructure. They are expected to spend a mind-blowing $534 billion through 2027. But here's the impending problem: diminishing returns. A year and a half ago, these hyperscalers earned 40 cents of operating income for every single dollar they invested in AI. Today, that return is halved to 20 cents, and analysts project it's trending dangerously toward just 10 cents.
Which leaves us with this final provocative thought. With returns diminishing and Wall Street pricing these tech giants for absolute perfection, what happens to the most leveraged stock market in US history the exact moment just one of these trillion-dollar companies decides to cut their AI spending? Seriously, keep your eyes on those earnings calls, because that is going to be our canary in the coal mine. Thanks for joining me on this explainer, and keep learning.